So looking forward to 2021, I think that probably leads us nicely into what the title of the year ahead is, which is Fiscal Forever, even in Europe. So is that to say that you think the policy reaction following this crisis in terms of, tightening fiscal policy again will be very different to what we saw in 2008?
Yeah, I mean, firstly, I'll give Giovanni Zani full credit for the title. That was his that I stole in the very end. But I think it really is an important message because we know this year was a big year for fiscal policy. The numbers we have are average budget deficits, the GDP of in the vicinity of 10%, which is unprecedented in a non-combat period. The big question is, does it continue? And I can tell you that a lot of clients we speak to are very skeptical. The assumption is that having had the fiscal response in the crisis, we're going to go back to tightening from here on in. And I would say that if there's one thing you take away from this call, it's our view that fiscal policy is not going away very quickly. I think policymakers look back at the tightening that they did on the fiscal side after the 2008 crisis and recognize it was a big mistake. And I think there's a desire not to make that mistake again.
And when you talk about skepticism, I guess the kind of subpart of that title about being even in Europe is the really important part there. You know, our investor survey kind of showed that there was, to a certain degree, a belief that fiscal policy will continue to be expansive, but there's still a lot of skepticism around this happening in Europe to the same degree as it will happen elsewhere. Clearly, we think differently. So can you tell us a little bit about that?
Yeah, I think the market just has a difficult time believing that the construct of the euro area is capable of delivering fiscal policy. And we've been saying all year that they've done it and the numbers are there. No one believes it. We're saying the next year it's going to happen again. No one believes it. I think people are very skeptical about the recovery fund ever being passed. We think it will be. So this is, I think, the big debate that we will have with clients in 2021, the belief that Europe can deliver fiscal policy, and as a result of that, a pretty strong recovery.
So we think fiscal policy is here to stay in Europe. We obviously have this kind of other layer of support from the ECB and the recovery fund, as you mentioned. At the same time, we have COVID trends kind of turning. But then if you look at the US, we have, still worsening COVID trends there. And now actually fiscal policy being questioned sort of now that we don't have that kind of blue Democrat sweep that we were expecting. So what's our view on the relative growth trends between the US and Europe, and how do we see that playing out in markets?
Yeah, listen, I think that there's long-term issues around COVID. There's short-term issues around COVID. And I think one of the big themes into early 2021 is going to be what we call the growth pivot. So things are looking better in Europe. So we think last week's flash PMI should be the bottom. The COVID trends are looking much better. Credit to Imogen and the Euro team for the work they've done on signaling that weeks ago. And at the same time, the US is just at a different point in COVID where you're in a third wave. Cases are still accelerating. Shutdowns are just beginning. So no matter what happens through the course of next year, we're going to have a 3 to 4 month period where Europe's getting better, the US is getting worse. And I think that has implications for currencies and for rates into early 2021.
Okay, I think that provides a nice segue, well, slightly away from COVID and now perhaps onto inflation, because I guess if we put this all together, we have this fiscal policy paradigm shift that we're talking about, coupled with a vaccine, that together we think will stimulate a recovery next year. So that surely must mean that there's upside risks for inflation heading into 2021. And it certainly doesn't feel like that's what's being priced into inflation markets at the moment.
So let me give you another yes and no. So yes, I think the medium term risks to inflation are to the upside, and I'll explain in a second. I'd say no, the risks right now are pretty benign. And what I would say is I think our global economics team did a great piece a couple of weeks ago that went well into the weeds of what's happening in core CPI in major countries during this COVID crisis. And quite interestingly to me, if you separate the parts of the economy that are affected most by COVID from those that aren't, what you see is that we're in the middle of a very predictable demand shock on inflation that's been driven by the sectors that matter most for COVID, things like transport and restaurants and other things. And everything else hasn't done anything. And so all those debates that we've had with clients, you've had them, I've had them, on inflation going up, inflation going down, the reality is we don't have an answer yet. You want to see that part of core inflation that isn't affected by COVID do something. And my guess is that we'll start to be able to answer that question second half of next year. And certainly our view, and we've written about this many times, is that what you're going to find is inflation risks are probably more up than down. And part of it is the policy response, which it's just incomparable to what happened in 2008. The fiscal lever is a much more inflationary lever. I'd also say that we should all recognize that there were foundations for higher inflation in place before this crisis. And my guess is that the crisis has probably accelerated that process. So again, we don't know the answer yet. And that debate is going to go on throughout the 2021. But my guess is by the second half of next year, we'll start to learn more and would not be surprised to see inflation higher than people expect.
Final theme from our kind of year ahead outlook was about the ESG landscape. And we made the call that sustainable finance markets will hit critical mass in 2020. Can you just talk a little bit more around why we think that is and where we think the developments might come from?
Yeah, so I think the best indication of what I call the macroization of ESG is the fact that I'm talking about it. Listen, ESG has been an incredibly important market over the last 4 or 5 years. But what's happening at the moment is it's moving much more into the macro space. And we look at that from kind of 3 different threads in terms of what happens next year. So firstly, governments across the world, including what looks like potentially the US finally, are making big commitments to climate change. And impressively, they're also making big commitments to bond issuance to fund that climate change. Clearly in the Euro area now, even in the UK, and we hope at some point in the US. Central banks are becoming facilitators. They're creating incentives for firms to issue green bonds, so to speak. And regulators are speeding up the process of making green bonds much more transparent. What is a green bond versus not a green bond? So it's very exciting. I mean, for us, we're doing things like building green bond curves in our curve analytics. So I think this is something a year from now we're going to look back and recognize that 2021 was a real turning point for this market and looking at it as a liquid market within the liquid market space.